set, let's go and talk about support and resistance. Now, before we get started, I also want to wish everybody a happy, healthy, and prosperous 2020. Ooh. Yep, we're here another 24 hours, 36 hours. We'll be into 2020. Now, in today's class, I'm going to use the term security, but I also might use the term Bitcoin, or I might say Euro, I might say Facebook, but I'm not talking about any particular asset because we're talking concepts that fit all publicly traded financial instruments in which an open market exists. Similarly, I intermix the terms investing and trading. We're all here because we're traders. We know the difference between investing and trading, but in either case, the basic concepts and techniques presented in this class are equally adept. Now, whenever I'm doing a conference, a seminar, a one-on-one, whether I'm meeting new traders, old traders, professional traders, it seems like the first question people ask me is, should I buy today? What should I sell today? When? What will prices be next week or tomorrow? The funny part is they ask me about gold, they ask me about oil, and they ask me about Bitcoin. Three things that are totally unrelated, but they ask. Now, the fact is, I don't have a crystal ball. I don't have a Ouija board, and anybody who tells you they do is full of it. If you're attending this class in the hopes that technical analysis has the answer to these questions, I'm afraid I have to disappoint you early. It doesn't. However, if you're attending this webinar with the hopes that technical analysis will improve your investing and trading, I have good news for you. That it surely will do. Now, today we're talking about a concept called support and resistance. I describe this concept as if you imagine an elevator and the floor below your feet is what is currently supporting you. Whether you're on the second floor, the fifth floor, the 19th floor, the floor is your support level. In order to reach the next level going up, you have to break through that ceiling. When you break through that ceiling to reach that next level, that ceiling becomes the floor under your feet or your support. If the elevator is coming down, it just reverses the scenario. Now, the fact is, whether we're talking about a 4-story building, a high-rise office building, a huge tall hotel, all those floors have different support and resistance levels. And when you can figure out where that elevator is going to stop, or not where it's going to stop, where, by looking at statistically knowing where that elevator has a predefinition to stop, you can make certain predictions. Like if, say, for instance, you knew this great big 50-story building had a restaurant on the 22nd floor, and that restaurant served lunch and dinner. The rest of the day was closed. Now, it might stop on the 22nd floor for employees to go to work, cleaners to go in, deliveries to come. But you know, when that elevator is going up between 11:30 and 2, there's a good chance it's going to stop on the 22nd floor because there's lots of people going up to that restaurant for lunch. When the elevator's coming down, there's a good chance. But at 9 in the morning, what is statistically possible? Okay. Now, all day long, there's all types of people coming in and out of that building. But by after 7 o'clock, the building's fairly empty. It's mostly commercial. Okay. So then the odds are of that elevator stopping on the, or going straight up to the 22nd floor increase. But we know that the 22nd floor is a major price or a major level of importance to price when it's going up or when it's coming down. Now, by ascertaining why and when that price would be important, we can make certain decisions about our trading. And we can call this support and resistance. Now, support and resistance is one of the most widely used concepts in Forex trading or trading in general. Strangely enough, everyone seems to have their own idea of how to measure support and resistance. And this is one of the things. Support and resistance is not a definitive step. It's not a defined number. It's not a mathematical calculation. Now, we can get support and resistance levels from mathematical calculations, such as using Fibonacci levels or what we call pivot points, but these are not accurate like personalized, what I call eyeballing. Okay. And eyeballing is what support and resistance are. It's no different than that doing the analysis of that restaurant on the 22nd floor of that 50-story building by looking over the past and calculating times and days and heights and levels. Okay. You can then put some type of concept to when that price or when that elevator would statistically most likely stop at that 22nd floor. The concept of support and resistance forms the basis for technical analysis. Now remember, everything and anything we do on a chart falls into the area of technical analysis. And to find support and resistance areas, we look at historical movement on charts. And traders look to buy at or near areas of significant support in an uptrend, or to sell near areas of significant resistance during a downtrend. Now remember, if you keep the concept of floor below your feet, ceiling above your head to define support and resistance, it's easy and you won't get confused between support and resistance when price is going up and when price is coming down. Because these two ultimately reverse themselves, just like the floor becomes the ceiling and the ceiling becomes the floor. Same with the concept of support and resistance. Now, you may have heard the old cliche, buy low and sell high. Forex traders and most traders usually ask the question, how low is low and how high is high? One way we can quantify these levels is using areas where price has stopped and changed price in the past. The area where price stopped after moving up and then turns around is called resistance. Resistance acts as a ceiling, capping the future advance. Now, resistance is not just some random area where price turns around. These are potential sellers or traders who have sold a Forex pair and remember those particular prices. Now, if we look at a price historically, a price movement, what we get is we get buyers entering a market. And it's very hard for buyers to start pushing up the price. But when they start jumping in the market pushes up and up and up and up and up and up and up. At some given point, the buyers that are still on the sideline are going to say, that price is too high, I'm not going to buy. And the buyers who had bought early take their profit and jump out of the market. What happens is the price then eases down. As price eases down, it finds a new level where these buyers who were sidelined are willing to jump back in the market. And these guys who had sold early and took their profit are willing to re-enter the market. And price will then start to move back up. So this becomes the support level where when price is falling the next time, it will most likely be held up or supported. As it moves up, buyers and sellers can be watching this price very closely. If price moves up and moves through that price, it will set a new resistance level or a new top. Now, like I said, there are lots of ways to get them. I am a firm believer in what I call eyeballing. And that is going back, and we're going to go through and we're going to go over and look at one of my charts. And that is going back and looking how price acted in the past. So let me pop up a chart, and then we're going to look at a little presentation I got prepared for you. Okay, what we're looking at is my standard teaching chart, my Euro US dollar 30-minute chart. Okay, I color code my support lines. There's no necessary reason you have to. There's no rule about it. There's no law about it. I do this because it tells me something about them. You can do whatever you want to do. But the gold line's up here. The blue line's here. the red lines here. Now, the only ones that have any importance to us are the levels above and below where price is. But because I didn't draw these lines today based on where price is, these lines were brought forward historically. These are the levels that price in the past is stopped and hemmed and hawed at. So if we go back and look for when price was trading in these areas and look for other times that price will help us define. So let's go back. The easiest way to do this is I go back and look at longer term charts. We're looking at a 30-minute chart. So if we go back and go, say, out to a 4-hour chart, we can look at where price has had other times where you've had, see this blue line here? Look how important this price was last week. But this price was brought forward from way back before. When price was below it and trying to move up to it, look how important that price was. That tells us that's a major support line or resistance line. Either way, if price is above it, coming down towards it, it's going to support the price. Price is below, moving up towards it, it's a resistance line. Okay. Here, we didn't have that much activity here, but when we look back in the past, there was a lot of activity at that price. These lines are drawn on the chart and will be brought forward and forward and forward. But the only ones, like I said, that are important to us right now are the ones around the current price. Now, if we were to go back to a longer period chart, we can find, now look at all of those lines that I have on my chart all the way back. All of these lines have been brought forward from historical times when prices had a particular importance at a specific level. And these are then brought forward into the future. But again, the only ones important to us are where price is trading at the moment. So these red lines below, or all these red lines up above, will have no really validity right now. But when price moves back to those areas, they'll come back into action. So let's go back to our 30-minute chart. And so now, look how important this gold line was. It was brought forward from way back when. But look, when price topped out here, what happened? Okay. Look at this gold line. All of these prices just closed, and all of these opens and closes, tops and bottoms, but could not break through that support line or that resistance line. So that made it a very important resistance level. Here we have my blue line that was brought forward. This is a very important support level. Even though it had good firm reaction here, it was valid from historically. We know when prices in this range that 111,805 is very important. And look at how price is staying right now for this whole day in between this level. So I've got a little presentation I'm going to share with you that might show you this or explain this a little bit better. And then we're going to go on and talk about how we would use this information. Now, before we start the presentation, if you notice on your screen, I don't know if you can see it right now because we're going to start the presentation, but if you notice on your screen, there is three downloads I put up there for you, 3 handouts. One is the Introduction to Technical Analysis from investing.com. That's an excellent guide. Just click the download button. There's no registration or anything. Put it right on your computer. There's also a support and resistance little short video preparation I did for you, which I'm going to share with you in this class. But this way you can download it and watch it at your convenience. It's very, very short, and it'll download very quickly. And then I put all of that we're learning today in a guide called the Support and Resistance Indicator Guidebook. So when you have a chance, click on those download buttons. They're only available during the live class.
So apart from helping us to identify potential trade areas, One of the other common uses for support and resistance is helping us identify whether a market is ranging or trending. If price is making higher highs and higher lows by breaking resistance levels and using them as support, then the market is said to be trending upwards. And if the market is making lower lows and lower highs by breaking support levels and using them as resistance, then it is said to be trending downwards. If the market is moving sideways between two levels of support and resistance, then the market is said to be ranging, as it is not making any significant movement to the upside or the downside. Some traders have strategies they will only employ if the market is trending or ranging, so using this analysis helps them to decide whether to implement a particular trading strategy or not. So why does support and resistance work? Put simply, support and resistance areas work because lots and lots of traders are watching them. Traders identify these areas because you tend to get a lot of trading activity at these levels. Some traders will be waiting to trade the reversal at the identified area, and other traders also like to trade the breakouts, whereby price breaks through the support or resistance area and the trader takes the trade in the direction of the break. So if price broke through a support zone, the breakout trader would sell the market in anticipation of the price falling further as it has broken through a support area. All of this increased trading activity usually results in either a victory for the buyers or the sellers, and because more traders are active at these levels, the reversal or breakout usually happens with some purpose and intent, which is what makes trading these opportunities so attractive to traders. However, it is worth mentioning, as with all forms of technical analysis, support and resistance is an art, not a science. There are going to be occasions where the market seems to forget that a support or resistance level is even there. It may just blast straight through it without even giving us an indication that any kind of reaction took place there at all. Or it may break a particular support or resistance area and then reverse, having already broken the area. We call this a fake break, and it can trigger breakout traders into a losing trade. It can also frustrate reversal traders, as the signal for the reversal doesn't happen in the identified support and resistance area. What we as support and resistance traders have to do is have other mechanisms within our trading strategy to refine which opportunities we take at support and resistance levels, other than just identifying them and waiting for price to reach them. If trading was that easy, we would all be millionaires. So how should you use it? For me, support and resistance is a key part of my trading strategy, but I do not use it in isolation. I have other analytical techniques that I use and wait for to give me confluence before trading. If I were to trade solely using support and resistance, I wouldn't be profitable, and it's as simple as that. I personally think support and resistance works best when you use it as one of a few layers of technical analysis that make up your trading strategy. For example, you could use it as the foundation of a strategy and build on it with a few different types of dynamic support and resistance, like moving averages and Fibonacci levels. Or you can use it to build on a strategy where the foundation comes from something like Elliott wave theory and look for a particular candle pattern when both streams of analysis line up. Like with any successful trading strategy, you need to have more than one analytical method. If you have a few and all the analysis lines up for a particular trade, then this gives the trade confluence, as it has a number of factors telling you there is a good chance this trade will be a profitable one.
Now, there are many ways to locate support and resistance. Similar to the one that I use, and we're going to spend some time looking at eyeballing, and is using swing highs and swing lows. When you're using a short-term chart, you can look at the tops and the bottoms of candlesticks and find and identify the lowest low and the highest high, and use those as a method of identifying current short-term support and resistance. Now, the easiest support and resistance levels to add to your charts are what we call pivot points. Now, I don't use pivot points at all. Lots of people do. But pivot points are mathematical calculations. And a lot of charting services and a lot of platforms will automatically add these on. All you have to do is click on support and resistance. Now, pivot points come from a mathematical calculation that uses the open, the high, the low, and the close, and gives you these levels above and below the current price. Now, if you're using pivot points, they are constantly changing. You set them to the time frame in which you're looking at, and it does the calculation. And it'll give you support 1, support 2, support 3, and resistance 1, resistance 2. These are the 3 levels above and below the current price. But because they're just mathematical calculations, I don't use them because to me, it doesn't tell me much of anything of any reliability. Now remember, markets ebb and flow. They go up, they come down, they move sideways. The primary way we make sense of these movements are analyzing the price action as well as the levels in the market where price bounced higher or rotated lower. And we call these levels support and resistance. Now, as price action traders, support and resistance levels form the foundations of technical analysis, and they help us build a framework from which we can understand the market. For price action traders such as myself, support and resistance levels help us plan our stop loss placement and our profit targets. Perhaps more importantly, these levels give us a way to make sense of the market in terms of what it has done, what it is doing, and what it might do next. And these are 3 very good concepts: what it has done, what it is doing, and what it might do next. So as I mentioned, we can get these levels off of swing highs and swing lows, but they don't hold, to me, much validity outside right now. But they do work. Don't misunderstand me. They do work. Okay, but they're short-term swing highs and swing lows. And then we get dynamic support and resistance from what we can use moving averages. Moving average lines give us support and resistance above and below the moving average. So that's dynamic because it's always changing. Okay. And you can combine dynamic support and resistance levels into specific periods. Then we have, of course, the 50% retracement level, which most people think of as part of Fibonacci, but it isn't. It's from Dow theory. And it holds that when the market has gone up, it will most likely retrace to 50% of its prior move or when it's gone down. And that gives us a very good support and resistance level. But I use, like I said, eyeballing, which I showed you in a short example with my current Euro US dollar chart. But I have put it together in a presentation for you. And I'm sorry, it does get a little monotonous and boring because you have to have a starting point to draw these lines on chart. Remember when we went back and looked at my chart in the 1-day level? There were all of those lines on that chart. Well, all of those lines had to come from somewhere. So since I need to get you started from scratch, I need to start you from somewhere. So I'm going to share this little presentation with you, and it's going to show you exactly how to start from scratch using long-term swing lows and swing highs or areas where prices stopped in the past.
So let's start with what support and resistance is. I think when a lot of traders think of support and resistance, they think of pinpoint lines on a chart that try to predict where the price will turn on a dime, but it's more complex than that. Let's start with the basics. Support and resistance refers to the technical analysis of price areas where the price action will potentially pause and change direction in any given market. If there is a price area below the current price action that has the potential to stop the price falling further and change its direction, we call this support. If there is a price area above the current price action that has the potential to stop the price rising further and change its direction, we call this resistance. Price can and does break through these price areas all the time. Typically, when price breaks through a particular price area that has been identified as either support or resistance, it will become the opposite to what it was before. So if price is rising and it breaks through an area of resistance, that resistance area now becomes a support area for the price. And the same is true in reverse. If a price is falling and it breaks through an area of support, that support now becomes a resistance area for price. There are different types of support and resistance levels, and I like to split them up into 2 categories: static support and resistance and dynamic support and resistance. Static, as the name suggests, are support and resistance areas that don't move. They are identified by the specific price level that the historical price action has shown them to be at. This is the main type of support and resistance people know and refer to when they talk about it. Dynamic support and resistance is the opposite. It refers to support and resistance levels that move. They are not at a fixed price. I use two types of dynamic support and resistance areas as part of my trading strategy, which are daily pivots and moving averages, and these levels change regularly. Daily pivot levels are specific levels of support and resistance that change on a daily basis. So I will have a set of daily pivot levels plotted on my chart on the Monday, and then these levels will change on the Tuesday. Monday's pivot levels are now no longer of interest to me on Tuesday, as all the levels have changed. Moving average levels are dynamic as well, as they are constantly changing with the formation of every candlestick. Dynamic support and resistance levels, such as daily pivots and moving averages, usually plot themselves through indicators within a charting platform. So if you add the daily pivots and the moving averages to your chart, the levels will update as soon as they need to. Static support and resistance areas usually have to be identified and plotted manually. So let's look at how we do this. We can identify these price areas by looking at the historical price action on our charts. We are looking for price areas where the price has been heading in a particular direction and then has stopped and reversed in the other direction. Equally, we can spot an area of support or resistance if the price has been heading in a particular direction and has paused for a significant amount of time before breaking through the area and continuing in its original direction. Sadly, support and resistance areas aren't as clean in reality as demonstrated by these illustrations. So let's jump over to the charts and look for some real life examples. Okay, so here we have the daily chart of the FTSE 100.
Now, as I explained, this is going to get a little bit boring, but please bear with us and follow along, because this is exactly how you need to start your charts. Once you have these on your chart, you just have to bring them forward, but you'll have it in your toolbox. It's just a little bit time consuming to explain it so that you get it right on your chart.
FTSE 100, and as you can see, currently the price is up at the 7,300 level and has spent the last couple of months around the 7,000 level. Now, to demonstrate how to identify and plot support and resistance areas, I'm going to scroll back on the chart to the last time the price was in the same region as it is now. This way we can use the support and resistance areas we plot from the previous price action to see if they have any significant impact on this price action that's happened over the last few months. So I'm going to draw two red lines, one above this price action and one below, very quickly. There we are. Now we want to scroll back and find the last time that the price was between these two lines so we can use it to identify and plot the support and resistance areas for this price region. So if we scroll back, we find that the last time price was in this particular region was sort of December, January to August 2016. So in order to start plotting the support and resistance areas, we first need to identify where they are. And as I said in the video previously, we need to spot the points where price has had a significant reaction. And to do this, we want to find where price has either been heading in a particular direction, has stopped and reversed, like here, or where it has stalled for a significant amount of time before either breaking through a particular area or reversing. So this area here, for example. And to plot these areas, I'm going to take my circle tool and I'm just going to first pick out all the reactions that I can see on this particular region of price action. So as I said before, I'm just picking out all the reactions where price has either reversed or stalled, and I'm just highlighting them so I can see them.
Now, keep in mind, the support and resistance levels are levels. They are not guaranteed exact prices. So keep in mind that everybody's going to have slightly different areas. And this is what allows you to personalize your trading and make you better than the next guy.
Them more easily. Fantastic. Okay, and now to plot the areas, I'm going to take my line tool and I'm going to work my way down the chart until I come to a reaction point. So the first reaction point I come to is this one here. And I want to encapsulate this reaction with the two lines. So I want to take the highest point the reaction occurs, and I want to try and place my line at the lowest point where the reaction occurs. And then once I've done that, I can delete my circle. So here we have our first support and resistance area. And then all we're going to do is work our way down the chart, picking out these reaction points, their lowest and highest levels. Another one here. Another one here. This one has more than just the one reaction from it, which is fantastic as it gives this particular area a little bit more weight in future use. Come down
now remember when I
further.
said I use different colors? Here's the reason. When I have a line that has had a particularly important, or many times that prices hit that line, I then call that a major support line, and I make my major support lines in different colors than I do my minor support lines. And this is what gives me my colors moving forward, because when I'm moving forward and I'm not looking at something that happened, a year ago, and now I'm looking at price, I know that that price was more important than other prices on my level, or that's a very important level. And that's why we have what we call short-term support and resistance. We have major support and resistance levels. We have minor support and resistance levels. And keep this in mind, but we all have our own techniques.
Yeah. So there. Actually, this one could probably come a little bit lower and encapsulate that reaction as well. And then we've got one down here to there, got another one here to there, and then we've got another one here to there, and then we've actually got another one here to there. And then we can delete our circles, as all of these reactions should now have been encapsulated in the areas that we've drawn. So that one has, yep, yes, 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 and yes.
Okay, so as I told you before, when you use your line tool, it's going to project those lines forward on your charts. Okay, and it's going to just go forward and forward and forward and forward. So once you put them on, and every time price moves to a different region, you need to have these. But once you put them on months and months and months ago, they will continue coming forward, so that whenever price moves into that region again, you have them. Okay, so we've gone over the major types of support and resistance and how I use them as indicators of market conditions. We've looked at levels to buy or sell from. We've looked at levels to define risk and its frameworks to understand what the market has done, what it is doing, and what it might do next. So when you combine a solid understanding of support and resistance levels, these price actions and market trends, you have a triumvirate of trading. Now, let me show you how we actually use this in the real world. Okay, and this is the little presentation I also gave you to download. You can click on your in the handouts and download. It's very quick, it's easy, and it just shows you how you would use support and resistance. Now, if you notice, the narration is right on the screen because I can't overtalk while the presentation is showing you, but I put everything. So support and resistance doesn't have to be confusing. We can mix and match any of the methods and create a healthy amount of price levels that we can trade. As always, practice makes perfect. So make sure to test out these methods yourself in a real-time demo account on alvexo.com. Just go to www.alvexo.com, use their charts, and just click on the support and resistance. You'll see how pivot points are just dropped on there for you. And make sure you download those handouts I gave you because they'll give you all the strategy and all the understanding. So I'd like to take a minute once again on behalf of investing.com and Alvexo and myself to wish you all a happy and healthy and prosperous new year. As we roll into the new year, hopefully you'll all be joining us for all types of trading events in the new year and do very, very well in your online trading. So thank you very much for joining us, and we'll talk to you again in the new year. Bye now.